Hello, and welcome to Smart Mortgage Insights. I'm Mandy LaRose.
And I'm Conor Levinka. Today we're going to talk to you about a curious thing on most loans out there, and that is an escrow account. You hear a lot of different things about it, and sometimes it's a little bit difficult to understand. So we're going to kind of decode a little bit about what an escrow account is today.
Absolutely. In our industry, you hear the word escrow a lot. We went into escrow. We put down escrow, my escrow account. I'm closing with the escrow closing officer.
What does all that mean?
There's a lot of escrow going on. Yeah. So today, like Connor said, we're going to talk about your escrow account. And what that refers to is actually your taxes and insurance. So we're going to kind of deep dive into that a little bit. When you close on a loan, one of the first things, actually, not even before you close, when you're getting pre-qualified and everything, we're going to go over numbers with you, a cost sheet on what you're going to qualify for. And it's going to first start with your down payment, your interest rate, things like that. Then we're going to go through what the closing costs are, and those are the fees to actually do the loan. But then we're going to go over what we call prepaid expenses. And those prepaid expenses are basically paying for future taxes and insurance on the loan. So we will break that down for you and kind of go over exactly how that works. But every month when you make your mortgage payment, your principal and interest is going to go off to your loan. The mortgage insurance, if you have mortgage insurance on your loans, is going to go off to the mortgage insurance company. But then those taxes and insurance are going to go into the escrow account. And the money is going to accumulate into the escrow account until those taxes and insurance come due on the property. So you're going to pay your taxes and insurance in like a basically broke down, divided in a 12-month period of time, and make that on a monthly basis. And that money is just going to kind of accumulate in the escrow account. I like to call the escrow account like a placeholder. Really.
I like to call it a forced savings account.
There you go. Yep.
It's your money.
Yes.
It's your money, and you'll see it on your statement every month. There will be a little thing that says this is your escrow balance, but it's always going to be your money.
Absolutely.
But as Mandy said, there's a couple of things that have to happen. So when you buy a house, you have to pay taxes on that house, and typically counties and municipalities collect taxes between once and twice a year, and those taxes, they can be in the thousands of dollars of range. So to avoid you having to write a check when that is due, we set aside that money for you once a month so we can afford to do that. And so the other thing is you pay insurance on your house once a year, and that insurance is paid typically once a year on the anniversary of your loan closing.
Yeah, so that's with the insurance. Of course, the property taxes are based on the house you're buying. So those are set taxes, that's set with the property. So we're going to determine what those taxes are based on the city that you're living in. But the homeowner's insurance, you actually get to pick who you want to use for your homeowner's insurance. So we generally suggest starting with like whoever you have your car insurance with or other insurance
Bundle
with.
things.
Yeah, absolutely. A lot of times you get breaks for having more than one policy, things like that. We do encourage you to do some shopping around as well. Of course, we will always give referrals, and anyone you're working with will give referrals as well. So you will be able to pick who you want to use for that. So like we've talked about, you're going to be making that in a monthly payment type of thing. We're going to divide it by 12 and make it monthly. But initially, when we close on that loan, we are going to collect enough money so that you're covered that first year on the mortgage. Because the last thing you want is to be getting notified that, hey, your taxes are due, or like Connor was saying, here's a $4,000 bill to pay your taxes for the year, or whatever that is. So we are going to collect enough money up front at closing to make sure that you have enough money in that escrow account to pay the taxes. Right now in the municipality of Anchorage, our property taxes are coming due. So when we're closing on a loan, a seller is paying their portion of the taxes, and then we're collecting enough for the buyer to make sure that the buyer has enough taxes to pay those taxes through the year as well. One thing about the escrow account is it is reviewed once a year.
It is required to be reviewed once per year. And in addition, that requirement needs to have a minimum of 2 months of reserves in it at any given time. That is if insurance goes up or if taxes go back. Wait a minute, taxes always go up.
Yeah.
So taxes going up. And so they review that, and if they find that they have saved too much in that 2 months reserves, they will write you a check, and you'll get it in the mailbox. If they decide that they are not collecting enough, they will actually ask you to make up the difference or add it to your payment over the next 12 months. So when we give you a mortgage payment, a to the penny amount, that is going to change pretty much, we can guarantee, on a yearly basis based on your taxes and insurance.
Absolutely. Principal and interest, of course, is always going to stay the same unless you have an adjustable rate or something like that. But those taxes and insurance, they can change yearly. I suggest to people, of course, the property taxes, there's not much you can do about that. Well, yeah, there is actually. Get out and vote. And
Yes.
that can help with that. And
Definitely.
definitely do that. But your homeowner's insurance, I suggest calling and speaking with your homeowner's insurance coming at least once a year. And reason being is to make sure that you have enough insurance that's being covered, but to also make sure you're not being over-insured as well.
Absolutely.
Yeah, insurance companies can only assume that you're just accumulating more stuff as you live in a property. So therefore you start to see that insurance go up, but just make sure that you're in the line of things as well and have that conversation. And then Conor said, they're going to review that escrow account. If it's short, they're going to send you a notice and basically say, hey, so your escrow account's short by $200. We're either going to divide that by 12 and add that to your payment monthly, or you can pay the difference on that if you
And
don't
keep
want
your
your
payment the
payment, and keep your payment the same if you're just really budgeting, want to keep that budget exactly where you have it set on a monthly basis. So some other options as far as not paying that escrow account. On government loans, VA, FHA, USDA, you're required to pay
Have
the
no
taxes.
choice.
Yes, you are required to pay the taxes and insurance in the payment. And again, if you don't pay property taxes on your property, the mortgage they can actually, take your property away. The city can't.
They frown
So
upon that.
yeah, they don't like that. So that's why it's encouraged or required that you pay those taxes and insurance in the payment on those government loans, because the last thing they want is for you to be foreclosed on. So, because you didn't pay the property taxes. On conventional loans, however, if you do put 20% down or more, you can pay the taxes and insurance on your own. We are going to make sure that your insurance is covered for the first year at the time of closing to make sure you're insured for that first year. But you can then pay the taxes and insurance on your own as you see fit as well.
But like Mandy said with budgeting, if you're comfortable with budgeting and you're comfortable with saving and you've put down a down payment of 20% or more, then yeah, absolutely. You have an option to not do an escrow account, and you would have a much lower payment every month. It'd be a principal interest payment, and you would just need to write those checks throughout the year for your taxes and insurance. So it's a personal preference. We find that most people do like the convenience and ease of having an escrow account, even if it's optional.
Absolutely. Yeah. I think the majority of people, they just are like, you know what, I'll just cover this in my payment. I don't want to have to be dealing with paying $5, $6, $8,000 later on for taxes and or insurance. So putting in your payment makes it easy, simple, but again, there are options to take it out of your payment as well. So that's an escrow account.
That's an escrow account. We hope you enjoyed learning a little bit more about that. As always, if you have any questions, please let us know. But otherwise, we will see you next time. This podcast is sponsored by Residential Mortgage, LLC, NMLS numbers 167729, 196, 576, and 1820404. Equal housing lender.